Hey guys, Tom here from the Investing with Tom YouTube channel. Welcome back to the channel. If you enjoyed today's video, hit like, hit subscribe, and that way you can see future videos as well. So the topic of today's video is twofold. The first one is about why growing companies tend to be hit less hard in their valuations with short-term events that really impact their business. And the second thing we're going to talk about is why, in my personal opinion and the opinion of Bill Ackman, the S&P 500 is not particularly reflective of the average business in the US. Now, before we get into that, we do have a sponsor for today's video, and today's sponsor is Hatch. Now, as many of you will know, Hatch have been my broker of choice for over a year now as a New Zealander looking to buy shares in the US. I started buying shares in the US probably about 2 years ago now, and the first time I did it, the options were very minimal in terms of where I could go to do that. I ended up going through a traditional bank and placed a trade that cost me $90 US. I can do that same trade now in Hatch for $3 US. So it's made investing in the US much more accessible for New Zealanders, particularly those wanting to invest smaller amounts of money. And one of the ways that I've really taken advantage of those reduced fees is when I buy into a company, it allows me to break up the amount of money that I want to invest in a business into a few chunks and kind of average down my price if the stock keeps going down over time. So that's something that's been really powerful for improving my returns. And it also integrates with another one of the tools that I use, which is Sharesight. So if you're interested in checking out Hatch, they do have an offer for you today. I'll put a link up on the screen here, which is hatch.as/investing with Tom. If you go to that link and deposit 100 New Zealand dollars into your account, you will get an additional $20 added to your account so that you can get started investing with a little bit more money for when you make your first purchase of a US stock. So I really want to talk about two things in this video. The first one is why certain technology companies are worth a whole lot of money for very good reason. And the second point, which kind of ties into the first one, is why I think the S&P 500 has bounced back so aggressively. And on the surface of things, it doesn't really seem to be reflective of what underlying businesses are doing. But there's some aspects with a lot of the companies that kind of dominate things like the S&P 500 that make them a lot more resilient to short-term events like we're seeing at the moment. So these are some points I actually picked up from watching an interview with Bill Ackman just yesterday. I will leave a link to that full video if you want to watch that down in the description below. And this is by no means like a market call or anything by myself or Bill Ackman saying that I think the stock market's going to go up or down or sideways or whatever. It's just kind of illustrating a couple of points on how the S&P 500 can differ quite substantially from the typical US business. So first, let's get into why some of these companies are so valuable. First, what you have to understand is that the price of a stock today is intended to be the present value of its future cash flows. So if you don't know what that means, basically it's saying that if I lay out money today to purchase shares in Apple, for example, or Amazon, it means that I become a part owner in that business. And as a part owner in that business, a rational price for me to pay for those shares would be looking very closely at how much cash Amazon or Apple are likely to produce over the lifetime of that business and distribute out to shareholders. So it's very, very important to understand what those cash flows are likely to be. And with growing businesses, we have something really interesting happen when we do these sorts of analyses. Let's take two very different businesses as an example. Let's take Amazon, which is a fast growing company. Its cash flows today are likely much smaller than what its cash flows in the future are going to be. And let's take also a newspaper company where their cash flows today are probably the highest they will ever be, and they're likely to kind of go down over time. So we have two very different businesses, and this is a really good example of where some simple valuation metric like a PE ratio really isn't reflective of the true value of each of these businesses. So you could buy Amazon, for example, for 40 times earnings, and you could buy the newspaper company for 10 times earnings. And if you were just to look at it on that simple metric, the newspaper company looks a lot cheaper. But if you were to run something like a discounted cash flow and see what the entire cash that each of those two businesses can distribute over its lifetime is, It's likely that paying up a little bit more upfront for something like an Amazon or an Apple that's going to grow a lot into the future versus a newspaper business that is going to be declining into the future can make that high PE ratio actually look really cheap. So, if Amazon is 5 times more profitable than it is today in, say, 10 years' time, then that 40 PE ratio all of a sudden comes down to a PE of 8 if the stock price doesn't move. So Amazon looks very, very cheap on that kind of future earnings basis. Whereas if you take that same newspaper business, which you can buy at, say, 10 times earnings, and those earnings go down by 90% in over the next decade, then you're eventually going to be sort of paying like 90 or 100 times earnings for on a future earnings basis for the newspaper. So if you look at it in that way, these businesses, the valuations at least can stray quite dramatically based on what their growth prospects are. And it means that the PE ratio really isn't the best way in the world to kind of analyze a business. Now, one of the things that means is that when each of these different two types of businesses goes through some sort of crisis or some sort of event, really the declining, slower growing business is going to be hit much harder than that. And that's because of some basic fundamentals of valuation. So I'm going to put a couple of screenshots up here. The first one is going to be a discounted cash flow of a hypothetical fast growing business. We're going to see our sort of baseline scenario, so what we expect the business to do, and then I'm going to change the first year of earnings in that example down dramatically. So the business goes through some sort of short-term event where those first year's free cash flows or first year's earnings are hit quite hard. And I'm also going to do the same thing for a declining business. So we're going to have our kind of base scenario of what we initially thought this business was going to do when we invested in it, and then we're going to do an additional scenario of, okay, after we invested in this business, it gets hit really, really hard with a short-term kind of one-year event. And what you'll notice is that the fast-growing business, in terms of its overall present value of future cash flows or a rational price to sort of value those shares at, the fast-growing business, much less of that company's valuation is driven by those near-term cash flows, the cash flows turning up in the next year or two. A lot of the value of those businesses is in cash flows 8 or 10 or 15 years out, for example. Compare that to our newspaper company, where we have a lot of the near-term cash flows, the cash we're going to get in the next 1 or 2 or 3 years, make up an enormous component of the valuation, because over time the earnings are going to go down, and really for a purchase price to make sense, we need to get a lot of our purchase price back in cash in those first couple of years. So what you'll notice is if we run some sort of estimates around like a short-term event, the fast-growing company is hit much less hard in terms of its overall valuation than the declining company. As long as that growing company can still execute after year one, the year one cash flows being hurt really don't impact the valuation all that much, whereas in the newspaper declining company, it really does. So that is a big, big reason why growing companies tend to be hit a little bit less hard a lot of times. By short-term events. You can still pay up quite large prices for them if they do execute on their growth plans. Obviously there's some risk that comes with that they won't, but if they can still execute and you can buy them at still a reasonable valuation, but perhaps even still a higher than market PE ratio multiple kind of valuation, then these fast-growing companies can still look very, very cheap if you take into account the long-term growth prospects that they have. Now, how does this all relate back to what's happening today? I thought I would bring up the example of the S&P 500. So I'm going to put up a screenshot here of the top holdings in the S&P 500. And what you need to know about the S&P 500 is that it's not an equal weighted index. So although it has 500 companies in it, it doesn't mean that you have an equal share in all 500 of those companies when you buy into the S&P 500. There are equal weighted indices and ETFs and so on out there that you can purchase, but a traditional S&P 500 index or S&P 500 ETF, if you were to purchase into some sort of ETF or index fund, those are market-weighted indexes. So what you'll see is that the top holdings are all the biggest companies in that index. So we see the likes of Microsoft, Amazon, Apple, Google, Facebook all make up combined around 20% of the index. And all of those businesses are still growing companies, some faster than others. Perhaps Amazon and Facebook are growing faster than Microsoft and Apple. But nonetheless, those are growing companies, and their valuations are driven, like we spoke about earlier on, by those longer term cash flows. The near term cash flows don't have as big an impact on the overall valuations of those businesses. So that is one of the reasons I think, and this is again what I sort of got from Bill Ackman, one of the reasons I think why some of these companies' valuations have bounced back up so aggressively in recent times. That's not to say they won't come back down again, but largely the evaluations are driven so much by those future cash flows that a shorter term event really has no impact on the valuation of the business. And even that said, a lot of these companies are in spaces where they can run their business remotely. They don't operate physical stores. They don't operate factories for the most part. Amazon has been absolutely booming through lockdowns worldwide. And even with Apple stores closing, people will still be scrambling to get their hands on the latest Apple products and all that sort of thing. So these businesses have shown themselves to be very, very resilient, and it shows that investing in high quality companies can do wonders for helping you sleep better at night and all those sorts of things as well. So fast-growing technology businesses are certainly not the average kind of mum and dad business over in the States, and it really shows that that is a major reason why, in my opinion, the indices are strained from the really high unemployment and that sort of thing. So that's my 2 cents on valuation and why companies in that technology space and really fast-growing companies in general tend to be worth a whole lot more money and don't get impacted so much in terms of their valuations by shorter-term events. Particularly, they're not as hard hit as declining businesses where you're trying to get a lot of the cash out of those companies very early on to make that investment make sense. So that's all from me today. I do hope you enjoyed the video. If you did, hit like, hit subscribe. If you're interested in that hatch offer, I will again put the link up on the screen here. Other than that, you can hit subscribe over there, watch some older videos over there, and I will see you in the next one. Cheers.